From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the data paints a mixed picture as PPI comes in slightly hotter than expected. After a soft CPI print bolstered bets in a big way on a September rate cut, and Treasuries erasing this year's declines as the traders weigh the Fed's next move. But we begin with the big issue, the road to September.
The economy looks as if it's slowing.
The CPI report.
It's a very welcome development.
A welcome surprise.
There was some normalization in some very abrupt moves that we saw in the May report.
That negative month-over-month print was a surprise for the market.
Inflation is a lagging indicator, of course. It's finally starting to catch down to developments in the economy and in the labor market.
On the PPI, the supply side simply isn't there to help what's happening on the demand destruction.
This Federal Reserve has been itching to cut rates. I think they'd be crazy to go in July.
They just need to be steady as they do this, because if they rush it, it's going to actually look like they're scared about something.
They will start to cut in September.
They should go in September.
The labor market looks as if it's coming back to normal. Inflation looks as if it's coming down. To me, this is a winning hand.
The data is going to be interesting to watch over the next couple months.
And I want to point out just how far we've come in just 11 days, because you were flirting with about 450 on the 10-year yield within that time frame at a high, and you've dropped roughly 30 basis points or more since then, firmly ending the week below 420 on that 10-year. Of course, the brunt of that move came first when you saw the labor market looking like it was weakening here with an unemployment rate rising. And then when you got the CPI data here, the consumer inflation print really coming in, showing progress on inflation. And now you have people betting on duration at a faster speed. When you look at the MOVE index, what's interesting here is that you do have volatility in the bond market, but you do have that volatility now finally subsiding. You just saw levels that were more elevated than they've been since 2019, certainly. Remember, back then was the pandemic. We have gotten to that level of volatility in that bond index. But really, since 2023, we have started to see it come down. We've seen spikes of it this year, but the direction of travel, even for volatility, is starting to be lower. And this week in front of Congress, Fed Chair Jay Powell spoke about inflation and what the central bank needs to see before they start cutting.
We want to be more confident that inflation is moving on a path sustainably down to 2%, not at 2%, but on a path sustainably to 2%. That's the test we've articulated. I have some confidence, as I said earlier, that we are on a downward path. I think if you look at the data, it's pretty clear that, but we have not said, though, that we have sufficient confidence, and that will be a decision that our committee makes.
Joining us now, Marilyn Watson from BlackRock and Jonathan Mondillo from Abrdn. And of course, we're going to talk about the big story is whether you see that September rate cut or not. But even more so, what kind of risk around there is it, Marilyn?
Yeah, so we have been thinking for a while that September is our base case. We think they'll probably tee things up potentially in July. We know that the Fed have been very, very data dependent, and the market, as you showed, has been incredibly volatile over recent months, particularly if you look at end of last year when the market was really pricing in steep cuts. Then this year they were even at some stage pricing in a hike. And now I think we have seen a lot more data. I think the Fed has been very, very patient. And now, with the labour market is still in a very strong, robust place, but it is softening. So the CPI and other data is coming down. And so in our view, we think, the Fed, is very well placed to, say, potentially cut in September and maybe once more again before the end of the year. And, July may be the point when they really start to indicate that.
What's interesting here, Jonathan, too, is you moved your expectation to September after you saw the CPI data, from my understanding. And do you still see risks around that September cut at this point?
I think it's pretty much priced into the markets at this point. To your point, I think headed into this week, we were not expecting such cool inflationary data coming out. So we did have a December 25 basis point cut. We've since moved that forward to September. And I would tend to agree that, I think July, the statements in and around the July meeting are going to be fairly dovish, and they're going to sort of lead into that September rate cut. I would also agree that obviously unemployment ticking up to 4.1%, statements made on Capitol Hill this week, sort of couching things as being relatively balanced now, with Fed Chairman Powell saying that one of the things that keeps him up at night is that labor market, rather than what we've heard over the last, let's say, 2 years where inflation was really front of mind. It's now shifted more balanced. So.
Well, do you think that 25 is enough, or do you believe that 50 will be achieved this year?
I think at this point, 25 is enough. We've seen a tick up in unemployment, but I still think that the labor market appears to be strong. Payroll numbers continue to come in rather strong, albeit not to the strength that we've seen over the last, say, 6 to 12 months. And unemployment is still low. I mean, growth hasn't really fallen off a cliff either. This is sort of that Goldilocks scenario that we've talked about, that soft landing as they land the plane. I don't think that it necessitates over-engineering things or sort of big cuts at the front of this cut cycle.
Yeah, Marilyn, how do you feel here? Because we have a story out on the terminal that is being extremely well read. This idea that October Fed's funds futures began flying off the shelves yesterday. This idea that the supersized rate cut could be more in view. What is the risk to that kind of thinking?
I think given all the Fed communication we've had so far, and given the fact that they are, we think, in a very strong position to start to cut rates now, but they don't want to make a misstep, and they do, I think, want to be very gradual, and they certainly don't want to be in a position where they have to reverse anything. We think it's likely that they'll cut in 25 basis points in September and again in December. I think really when you look at the data that we've seen coming out recently, then the labour market remains pretty robust, but so there are more job openings now. And really the strength in the labour market really resides in the services sector still, and not so much in the goods sector, in the manufacturing sector. I think also when you do look at, if you look at real rates, they're a lot tighter now than they were a few months ago, given the fact that inflation has come down quite considerably and rates have been at a relatively elevated level by the last 10 years standards, at least, for some prolonged period of time. I think now actually rates look pretty tight.
Well, speaking of that, too, you even have Barclays coming out recommending just today that you should short 5-year treasuries, citing election risk. And they say that the markets are pricing in too many cuts cumulatively, which is not consistent with the resilient economy and inflation risk following the U.S. election. Jonathan, have traders gone a little too far right now?
Yeah, absolutely. I mean, you look at the market pricing in 8 cuts by sort of December of next year. We think that it's a little bit overdone. And I think one of the things that you pointed out, too, between the December and the September meeting, we do have a sort of a large headline risk with the election. We could get a change in policy, change in administration, and I think that's going to have an impact on the overall economy. And some of that could be rather swiftly with executive orders, et cetera.
You could make a ton of arguments here, right? That, whether you get Trump tariffs in the future or more spending under the Biden administration, that there are inflation risks. If you see that first cut in September, you were talking about caution from the Federal Reserve. What is the risk that 2025 doesn't see as many cuts as the market expects, or even staying stable towards having a hike?
So yes, at the moment, the market is pricing in around 150 basis points of cuts from now on. I think on its current trajectory, then we think it's likely that the Fed will continue to cut rates, but it will be very gradual, whether it's quarterly or it could be potentially a bit faster in the short term, but it may well be quarterly. But as you say, I mean, it's really a 2025 story when you have whichever administration we have. And then it will be, I think, it will have an impact on inflation. You might have a difference in, obviously, regulation, expenditure, taxation. And so I think from there, it is a little bit less clear in terms of certainly the path of inflation and also, the strength of the economy.
Where do you think the 10-year ends 2025?
So it's hard to tell, but I think we would argue that potentially it would end up lower than it is here today. So we do think that inflation will continue to come down for some time. We do think that the Fed will, at this trajectory, continue to cut. But as I say, it is nuanced and it is balanced. But I think potentially being around here or lower, we would see the base case.
Do you have a view on where the 10-year ends?
Yeah, I mean, I think personally, I think this rally's been a bit overdone. But I do think that, between now and September, we could absolutely see it continue, and we could see the 10-year with a 3 handle, if you will. I think once we get the election cycle over with, it's anybody's guess based on, who is enacting policy as a result of that. I still think we are north of 4% come year end, though.
Year-end 2025.
Correct.
But do you see, depending on which administration does take over, do you see an inflation risk greater in one or the other?
Yeah, I think a continuation of Biden in the White House would be more of a continuation of his policies that he put in place over the last 4 years. I think you continue to see sort of inflation subsiding, growth sort of muddling along 2.5%. I think the real risk to fixed income markets is probably a Trump presidency, where some of his tariff policy would be, in our view, very inflationary, and was going to put pressure on the Treasury market and fixed income yields overall.
Marilyn, leaving you the last word on the consumer. You saw that Michigan data come out this morning, and some concerns moving forward. What are the ripple effects of that?
So I think it's all a pattern of we are seeing the economy remain resilient, but it is definitely moderating. And I think we'll continue to see that feed through into the rest of the economy. The labour market, say, is cooling. We are seeing a cooling in consumer confidence. I think next week we get retail sales, which will be obviously another key one to look. But I think we do expect to continue to see the economy moderating somewhat. And for all these different reasons, our positioning in the US Treasuries are really, we like the front end still, sort of out to the 5-year part. There we think, you still get very decent carry, you get very good yield, and you don't have the volatility and the risk that you get further out the curve. So I think in terms of our positioning, we are long duration, but at the front end of the curve.
Fascinating. That is Marilyn Watson from BlackRock and Jonathan Mondillo from Abrdn. Of course, a very busy week in the Treasury market this week, and more economic data for next week as well. Now up next, the auction block. Saudi Aramco pulls in a massive order book for its auction. We're going to look at the credit markets next. Stick with us. This is Real Yield on Bloomberg. I'm Sonali, Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where high-grade issuance picked up after tallying the slowest week of the year. Broadcom led the way with a $5 billion sale as it looks to refinance a portion of the loans it secured to pay for the VMware deal. Total overall U.S. sales passed more than $17 billion, and all but 3 of this week's sellers were based overseas. One other corporate sale that I want to highlight is Saudi Aramco. It pulled in more than $31 billion of orders for its $6 billion sale. It was the company's first dollar debt offering in 3 years and included 10, 30, and 40-year notes. And looking at this week's auctions of 3, 10, and 30-year treasuries, we saw mixed demand, with the 3-year auction drawing the highest bid to cover since January, while the 30-year saw the lowest ratio since November. And when it comes to credit, PIMCO is warning that the market returns are failing to compensate for the risks. The firm's CIO of Core Strategies wrote this week that liquidity premiums have compressed in both public and private credit markets, with lower quality segments of each facing elevated vulnerability to economic slowdowns and higher interest rates. This week on Bloomberg, Lauren Basmajian joined from Carlyle to speak about those risks in credit.
Default rates, there were all sorts of very high projections out there. We're at 1% as a market. That's much lower than long-term averages, which are between 2 and 3%, depending on the time frame you're looking at. I think the loan market is very bifurcated, though. So you could have, you see most of our companies that trade around par, meaning there's not really problems in those credits. And then you have about 4% of the market that trades under 80. And I'd watch that for more signs of stress. But again, that's the lowest it's been in 2 years.
Joining us now is Sinjin, Bowron, portfolio manager and head of high yield and leverage loans at Beach Point Capital Management. And it is a really good time to talk about risk, because clearly there's more people in the market who are getting concerned about kind of these slowing economic conditions, weaknesses in the consumer. Where are you seeing stresses emerging even more now than perhaps we did a couple months ago when we last spoke?
Great. Hi, Sonali. Thanks for having me on. we would agree that stresses are starting to mount. The financial conditions that which everyone was measuring and trying to price in when there will be, in fact, a change in monetary policy are good for a debate around what inflation will do and how economic activity will behave. But the leveraged credit markets are still having, technical tailwinds which have tightened valuations, and then they still have a tail of very levered issuers for whom 1, 2, perhaps even 3 rate cuts won't matter a lot in terms of how they will address their balance sheets. So that tail of the levered credit universe is one that we're watching.
Well, what does this mean for new issuance moving forward? If new companies are coming to market, the economy is weakening, do you think that there's going to be demand for leveraged credit?
Well, leveraged credit overall still looks incredibly attractive. Spreads are indeed tight, probably in the 10th percentile historically, though yields and price are still quite attractive, and that coincides with an overall fundamental picture which is still holding in quite well. Leverage is manageable, interest rate coverage ratios are still very healthy within the leveraged credit universe, and so there should be a persistent demand for credit in general. However, it stands to reason that when rates were raised, above 5% when inflation was running high single digits, now that inflation is around 3%, financial conditions continue to tighten, and each month of passing and will soon hit the record for the longest Fed pause in history. That tends to transmit through to leveraged credit, especially that lower tail, in negative ways.
Well, let's talk about high yield as well, because you kind of mentioned the valuation concern here just slightly. You're talking about yield, but you're also talking about that worry in spreads. And I think a lot of people in this market can't decide. Do valuations justify the risk you're taking on, and does the higher yield make up for it?
In general, yes, the higher yield does make up for it. On the lower end of the quality spectrum, there's not, it's underperformed its beta to the market historically. And so those return profiles, while attractive more recently, will probably start to tail off as financial conditions continue to tighten. This calls for greater security selection, greater care in terms of investment picking. But in general, that will likely turn into a very attractive market opportunity at some point.
One question I have is, where are the vultures? And the reason I ask this is because you do have S&P Global coming out earlier this month saying that U.S. corporate bankruptcies in June have reached the highest monthly level since early 2020, since the pandemic times. And so even if you're not seeing a wholesale swath of bankruptcies or the economy weakening drastically, you certainly are seeing pain, which a lot of people don't notice in a market that's been flying at record highs. So where is the distressed opportunity right now?
Well, it's a great question. Right now, defaults are indeed low, and we would anticipate that overall defaults will remain low given the overall health of the credit markets and strong fundamentals. Credits that do need capital and have had trouble accessing a regular way market for financing have turned to other more creative or aggressive ways. Some have turned to other asset classes. Some have resorted to what we call liability management, or LME, which sounds like a new term, but is actually as old as institutional credit itself. And we're seeing more and more of these transactions as companies and their sponsors try to address their near-term maturities.
Now, it's interesting. One of the big areas of the market here that people are really questioning as well is private equity-backed credits, right? I mean, speaking of ways that people are kind of extending and trying to get past this era of maturing debt into a higher interest rate environment, you're seeing that very pronounced in the private equity industry. Would you bite on anything that they have to offer?
Well, right now, M&A transactions are extremely low. The volume's low. The multiples are about half of what they used to be in terms of what sponsors are willing to pay for assets. And importantly, the composition of debt is also low. And so all basically feeds into a very strong technical tailwind for leveraged credit and high yield in particular. To the extent that more M&A is on the horizon, and particularly sponsor-driven deals in the form of LBOs, those potentially could be attractive given the parameters I just described in terms of having lower levels of debt and just building in a higher margin of safety to those types of transactions.
Just about a minute left here, Sinjin, but what is your favorite trade in this market?
Right now, given the events that have transpired over the past couple of days, we do think it's important to start introducing interest rate sensitive securities and instruments or duration into portfolios. We've lived through a year of this holding pattern within markets where duration and interest rate volatility have been headwinds to especially fixed rate securities within portfolios. We would expect that will now turn to a tailwind. At the same time, it's important to have a healthy dose of floating rate securities as well, simply to gather that carry that those offer as we head into the next chapter of this rate cycle.
Must have your vegetables with a healthy dose of floating rates.
That's
Bowron
right.
from Beach Point Capital Management. We thank you so very much for your time today. Have a great weekend. Still ahead, though, the final spread. The week ahead earnings season is in full swing. We're going to talk about what's next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, a big one. Monday, Fed Chair Jay Powell speaking at the Economic Club of Washington with David Rubenstein. You can watch that live on Bloomberg. Plus, more big bank results continuing to roll out with Goldman Sachs reporting on Monday. And Tuesday, we'll get more economic data with U.S. retail sales and Morgan Stanley and Bank of America earnings, of course, very interest rate sensitive. Wednesday, the Fed is releasing its beige book. Thursday, an ECB decision and Christine Lagarde's news conference. Plus, Netflix kicks off tech earnings after the closing bell. Finally, Friday, Fed speak from John Williams and Raphael Bostic. For my final thought, let's take a look at all the companies reporting earnings next week because, of course, yes, we have a lot of banks. Goldman Sachs, Morgan Stanley, Bank of America, a lot of eyes on interest rates, but a lot of eyes on the consumer. Johnson & Johnson, United, really fascinating after what you saw with Delta this week. What is the consumer doing, particularly after you saw the weakness that you saw today in the University of Michigan data? American Express, I'm probably more interested in that than anything else to kick off the week, not just because it's at the end of the week, but also because that consumer is in hot focus. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.